Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Brian Stutland, Chief Investment Officer at Equity Armor Investments, for an update in market activity. Brian, it's great to see you as always. Welcome back to Trade Talks. And I have to tell you, everything that's happening with interest rates, the inflation, concerns around the consumer, of course, the heightened geopolitical environment, seems as if the market and volatility indexes are taking it way more in stride than I had expected.
They really are. I mean, you look at all the geopolitical risks that's out there, and then you talk about the interest rate environment, Jill. And yeah, it's a dicey environment for this market, but yet it seems like things are somewhat muted. When I go and I look at the spikes index for volatility on the SPY or VIX, that measures volatility in the S&P 500, I look at those indices and they're sitting here below 20, basically their historical average area. But when typically they're below there, that's indications of a bull market or people feeling good about the market. And certainly, I don't know anybody that can feel really good about everything that's going on right now. And you'd expect volatility to be a little bit higher. So it becomes a little tricky when you're an options trader trying to decide whether you want to buy insurance protection by buying puts on the market, given the heightened premium that we're starting to see. But yet nothing has really exploded to the downside.
You're also concerned about what you're seeing in terms of price action with yields as well.
Yeah, I am. And as the 10-year sort of gets towards this 5% level, if it starts to tick above there and we start to see back that inversion in the yield curve, historically, that's been an indication of recessionary. After we've been reverted and it goes back positive again, that's when people get worried about the market. Now, historically, that's been because the Fed has had to start to cut rates on the front month. That's no indication. We heard Powell speak earlier today and basically saying, yeah, we need to continue to control inflation, but they're pretty much done with rate hikes for the rest of the year. So, I don't know if we get that necessarily re-inversion of the yield curve again. But still, the 10-year above 5%, that is worrying because now we're talking about borrowing costs that are very high relative historically of what we've seen over the last 20 years. Now we're getting back to levels back above the year 2000, and that starts to get a little scary on how the market can actually handle that.
What are your thoughts around earnings? We saw 20, I believe, out of 21 of the bigger banks beat earnings. It seems to be okay, but I feel like we're seeing that every season. It's okay. We're seeing beats. Of course, we're going against, expectations that have been lowered.
Yeah. Yeah, I mean, we are seeing beats. Tesla's earnings were actually a little concerning to me a little bit. I do like the stock. I own it personally, and I own it for clients. But when you look at that, obviously Tesla selling off, pretty significantly today, missing their earnings picture. That could be a little bit of an indication on the consumer, whether the consumer discretionary type stocks can really hold up through this whole earnings season. I'd start to get a little concerned about all of them in general in that sense. The banks held up okay. They're probably being a little bit more conservative in how they're investing and dealing with these higher interest rates environment. Now that we've been in this higher rate environment for quite some time, a little over a year, they obviously had some tough adjustments at first, and now they're making those adjustments. So we'll see how that plays out. I think it's going to be the bigger cap tech names that will lead the charge. We need to get some good earnings from there, and that could push the market higher as we're seeing sort of Microsoft names like that buck the trend in today's little bit of a sell-off.
Well, you know what? It's so interesting, Brian. It seems as if everyone's always betting against the consumer, and the consumer continues to surprise. But, I agree with you in the terms that the spend has really been on the services side of the economy, right? We had all that pent-up vacation spending, and everybody wants experiences and, all these services, I guess, revenge spending, if you will. But that's not necessarily recurring revenue to the economy, if you will. You can only go on so many, amazing vacations with your COVID savings. So I feel as if, the consumer's going to have to start thinking about discretionary spend versus staples types of spends with interest rates this high. Credit cards are 24 to 25%, right? But it just seems like every time you bet on the consumer, they're there.
Yeah, well, the consumer has been there in the market. It's a question of, in this higher inflation rate environment, the stocks and the profit margin ability of the consumer discretionary type stocks, I think, is starting to struggle. You're talking about rates where companies themselves have to borrow at higher rates. The ability for those types of stocks to buy back any kind of stock is a little bit more difficult if they're going to do that on a borrow and buy back kind of way. So just the market structure. And then you look at the valuation of these stocks being relatively high given the higher interest rate environment. And I think that's why you're not seeing the market crash out, is you're just basically seeing this valuation repricing, not necessarily the consumer falling apart or the banking system, where there's real, systemic risk in the marketplace. And I think that's why you're seeing these volatility levels that just can't get above, let's say, 20 on the spikes or 20 on the VIX. And you're seeing volatility somewhat muted. It's kind of a slow bleed down, a slow repricing of some of these names.
It's so interesting you say that because we had our chief economist at Nasdaq on yesterday, and we were talking about, year over year inflation. Once you get that year over year point and there's no raise there, you're technically at 0% in terms of movement. So it almost feels like the consumer, there has been a reset in asset prices across the board, not even just equities, and the consumer's just used to paying at these levels because in theory, year over year, there has not been a rise in inflation.
Yeah, I think that's absolutely right. I think that's why you're really seeing the Nasdaq basically bounce below and above this 15,000 level here, and just kind of moving around. Things get repriced slightly lower here, and but on the downside, I don't think there's a total crash out coming unless we start to really see the 10-year start to really push above 5%, and so. Anything that's sort of like a dip here, especially Nasdaq, let's say 14,000 on the low end here, that's where 13,800. That's where I see support happening if we continue to get a little sell off, and I'd be a buyer at that level.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.